Oh, I am so excited that you're here today because this is a conversation that as women we should be having at all points in our lives, whether we're beginning of our career, middle, late, it doesn't make a difference. This is something that we should be talking about at all times. And it's not always a subject that we like to talk about or has felt taboo. If you don't know me, my name is Renee, and I'm a financial planner and the founder of Nexa Wealth. I work with high earning women, executives, business owners, leaders who are doing incredibly well on paper, but they want more than just doing okay. They want clarity, they want strategy, they want to feel like every dollar that they're earning is building towards something much bigger. And sometimes it doesn't always feel that way. And so if you're here, I'm guessing you might be feeling something similar. You may have built some income, you may be earning great income, you may have built some assets, you've made some smart moves along the way, but there's still that little voice in you that's like, am I maximizing this? Am I optimizing? Am I doing the right things with my money? Or am I leaving something, important on the table? And a lot of times we have done the basic things, or we have done certain things, and those pieces of the puzzle fit together. But as we've continued to evolve and grow personally and professionally, sometimes those pieces of the puzzle no longer fit together. So there are some gaps and cracks, and we're like, hey, I don't really know how to make this fit again. So today I'm going to walk you through the 5 power money moves that I help all of my private clients implement. These are the ones that help them grow their net worth faster, invest smarter, and stop letting the taxes quietly chip away at everything that they've worked hard for. And I promise you, this is not going to be overwhelming. This isn't going to be full of jargon or hours of theory. This is designed to be really small trainings within the larger conversation. Each of these areas or each of these moves are things that you can implement immediately, but it's not a matter of trying to implement everything at the same time. So sometimes as you're reading or as you're going through this, it's about seeing which is an area that you feel like you can implement in the next 30 days and then check mark, okay, maybe let's do something else the following 30 days. And if you get stuck at any point, I am here. And because throughout this, at the end of this, I am also going to offer you a strategy call, a one on one strategy call, so I can help you make sure that you're implementing these pieces within your personal plan. So, with that said, a quick intro about me. If you don't know me, because there are, I'm sure, plenty of people here that have this is their first, and I have already see a mistype on my quick intro about me. So, this is when you know that, hey, I'm actually doing the one doing this these presentations. But jokes aside, again, I help high earning women who want more than just a steady paycheck. They're tired of either second guessing their financial decisions, sitting on the sideline with some money, making sure that hey, they should be investing, but am I investing in the right way? Am I investing with my values? And sometimes it's just a plan that just they used to have that no longer fits them. And our financial lives are dynamic. It is not static. So it is constantly moving and evolving. So we have to make sure that again, as we grow, that the pieces of the puzzle are fitting together. And honestly, I wasn't always a financial planner. So sometimes you may look at me like, oh, of course she's smart with her money. I was not always smart with my money because I wasn't always a financial planner. I was like many of you. What led me to creating Nexa Wealth and having a place for women like you to understand how to build wealth that matches your life, not just for the future, but also for today, because it's really about throughout your entire life without the complexity, without the jargon, to really understand what a woman's life and the chapters that we go through in life. That what led me to creating Nexa Wealth is my own journey. And I wasn't always smart with my money. I started in sports marketing. I was making good money, but I was ignoring my finances. And it wasn't until I was in my early 30s that I was like, hey, I really need to kind of make sure that I am being smart with my money so I can always rely on myself. It's not about wherever I was in my relationship. It's making sure that I, as a woman, always have those choices for myself. So my promise to you today is that I'm going to deliver as much value as I possibly can within this hour. But again, your financial life does not fit in the box of 1 hour. So we are going to hit the highlights, but if you need help along the way or something doesn't make sense, please reach out to me because I'm going to be available offering these one-on-one strategy calls. And what I teach you today is not just really about your money, but it really impacts your entire life. It impacts your professional life, your personal life, your emotional, your mental, your spiritual. Money is not just sitting in a silo, it affects every area of our life. So, just like in other areas of our life, when we're focusing on really being the best that we can be in one area of our life, it affects the other areas. And everything that you learn today comes from my own experience and the results that I've have achieved with my clients. And everything that I've done with my clients, I've also personally have done. So again, this is all about really making sure that you're getting real world actual advice that fits a woman. And you're in the right place. Like I said, if this sounds like you're earning well, but you're doing well on paper. So on the outside looking in, your friends like, oh, she's crushing it. But you're still wondering behind the scenes, you're like, am I really, is it all working out? Am I going to end up with no money later on? How much money do I need in the future? Or can I continue to live the lifestyle that I'm living today in the future? I really want to be enjoying life today, taking these trips and doing all these things with my kids, but I just want to make sure I'm not running out of money. And you probably have some like 401ks, IRAs, brokerage accounts, maybe some stock options, and you kind of feel like you're piecemealing this, and maybe you've outgrown those what you have been doing, and you're going to the TikToks, the Instagrams, and maybe Google and getting some of these webinars like this one and just trying to piecemeal it together, and you're not sure about what's really coming next. And also without feeling like you have to cut back on things, because so much of the advice that's out there is about cutting out, and we don't want to be doing that. You want to be able to make those confident money moves without the second guessing, without wondering, having to go back to Google or having to go talk to friends and family. You want to be able to stand in your own power and be able to make those decisions because you have the confidence and the understanding as to what moves you should be making, and you're not missing out on something big. So I love a good meme. This meme, unfortunately, I couldn't find this one with a woman, but if this is you, just trying to add up all these different numbers and it's not making sense, you're in the right place. Here's what most being in the financial space for the last 10 years, working with women, and before that, having conversations with financial planners. The reason why I got into this is because I didn't see anyone looking like me. I didn't see anyone giving me real life advice for someone, a woman who is in her 30s. I just getting all of the bro financial tips and talking over my head. And this is what most financial advice gets wrong. So when we're consuming a lot of this information that is from mainstream media, it doesn't account for, as women, how we care for others while we're building wealth for ourselves. So whether that is taking ourselves out of careers to raise kids, or working while we're also raising our kids, or caring for aging parents or family members, we tend to be the caregivers. So we have to have a financial plan that accounts for that without discounting at building wealth for ourselves. It also tells you have to cut the lattes. It has to, you can't maybe do the budget travel, and just so you can invest. And that's just not what we should be doing. Yes, we want to be investing with intention and with our values, but we don't need to be cutting out everything in our lives in order to achieve that. Life is too short, so we want to make sure that we're enjoying our life today without sacrificing our future. We want to save for the future without sacrificing for our current lives. And it also assumes that your income, because you make good money, because your income is increasing and you're earning more, maybe it's base and equity compensation, that you all of a sudden have all this clarity, know what to do with your money, and that your goals are simple. And for all of us on here, we all know as a woman, our goals are never simple. There's a lot of nuances to our goals. There's a lot of other people that we're factoring in, even if we are not in a relationship or we have kids, because not every woman wants to have kids, and that's okay. But it doesn't mean that we still are our financial lives or our goals are linear. And I hate the let's just invest more in your 401k advice or just put money into an IRA, put money into the S&P 500 and you'll be fine. We don't need those vague goals. What we need is specific advice for our particular situation. And we want to it treats like every goal. The financial world is like every time you read something about how to be smart with your money, it's like it's a retirement problem. And we don't necessarily always have a retirement problem. Your life is constantly evolving. So we don't want to just be saving for the future without thinking about all of the various things that are going on well before retirement. So again, if you, as we're going through this, there's going to be a lot of information. Take in what you can take in. You can always listen back to the recording. But if you need help at any point, I am going to offer a wealth clarity session, a strategy session for this way we can see where you are and where you need to be and the things that you're currently doing so I can make sure that you're implementing some or all of these tips at some point this year in your financial life. So I always like to organize. This is maybe the planner in me, but organize into a framework. So these 5 steps are my shift framework. We want to simplify your cash flow. We want to hone in your tax strategy, invest for your life, focus on taxes all year round, and protect and transfer your wealth. So we'll obviously go through each of these. When you think about it, all 5 of these pieces are always dynamically fitting, if that's a word, are fitting in with each other. It's not like, hey, we just simplify your cash flow and we don't have to think about taxes, or we don't have we thought about taxes and now we don't have to think about cash flow or transferring your wealth. They are always interacting with each other. So how do you go? A lot of, and I'm going to actually take a quick step back, is that a lot of women, regardless if they're making $100,000, 150, 200, 250, 400, 600, a lot of women will come to me and be like, I don't know where my money is going. And although I may not need to be looking at my quote unquote budget every single month, I know that I have the money to cover my bills. I actually don't know if I understand what's coming in and what's going out the door. So I know that I'm building the life that I actually want to be building. So that is the foundational piece of anything. And anytime we're starting to work together, this is the place that we start. We are to simplify our cash flow. And it's about building a system for your priorities. It's not about building a budget because I absolutely hate that word budget. It comes from a scarcity mindset. So I like to organize our cash flow into 4 buckets: essentials, lifestyle, luxury, saving, and investing. Now, these numbers next to each of these categories that you see here on the screen are general rule of thumb. When I am working with a client, regardless of how much they're making, we're organizing their expenses and where money's going out into these 4 categories. So the essentials, your housing, your food, the things that you need on an every day, every month basis. So whether that's rent, whether that's mortgage, whether that is, car payments, car insurance, the food, all of the things that you need to be fitting in your day-to-day life that cannot go away. If you were to lose your job or need to pull back in some sort of way, these are the things that you need to run your life. Now, the next category is your lifestyle. Now, as we make more money, we naturally build in some lifestyle pieces that are either going to help our lives be more convenient or they're going to just enhance our lifestyle. And that's not a bad thing. So the convenience factor may be the personal trainer or maybe the meal prepping service, the convenience things that are just helping your life be a little bit more convenient, right? Like I love to cook, but I don't always really have the time to cook, especially during the week. So I just get a meal service because I just want to make sure that I'm eating healthy meals and that I'm not sitting here just like, oh, I don't know what to eat. So I'm just going to like just end up eating pizza or something that I know is not going to make me feel good. I do love pizza. I am from New York. So nothing against pizza, but I will do a meal delivery service that is helping me get organic foods, and it's a convenience thing. I don't care about the cost. So to me, that is a lifestyle expense. Now, could I cut that out? Absolutely, but it has become a part of my essentials lifestyle, right? So when we think about our essentials and our lifestyle, it's almost like 55%, right? We could cut out the lifestyle, but it has become morphed into almost like our essentials. The luxury is 5%, right? Which is these are the things that we may not be doing on a regular basis, but they are some lifestyle things that really either make us feel like, hey, I work hard, so I'm going to enjoy life and I'm going to enjoy that to maybe the highest degree, right? That may be taking a really expensive trip, right? Like maybe an international trip, and you're like, I'm going to go first class and I'm going to go to the five-star hotels. These are the things that you're like, I'm going to be doing, occasionally, and let's live that life. It's okay. So maybe we put a little bit of money towards that 5%. And then the savings and investing is 20%. Right. So this is where a lot of times maybe it's the essentials, the lifestyles, the luxury. It gets morphed because we're making money. We're like, okay, yeah, we know that we can handle this, that the saving and the investing is kind of what gets sacrificed in some capacity. So again, we want to make sure we're creating space for the saving and investing. There's a difference between saving and investing, and I'll go through that. So, as an example, I have a client, Talia, 34 years old. She makes $185,000 from her business, right? So we can say whether it's your business or whether it is your corporate job, $185,000 of income. When we went through her expenses and we looked at how to divide out or where she is currently, and maybe making some tweaks, we said, hey, about 52% is on the essentials, where 18% is on the lifestyle and a little bit more on the luxury. And then 22% is on the savings. So again, there is an opportunity to maybe save a little bit more or to adjust these percentages based on your situation, but trying to get as close as possible, right? It's not like, hey, oh my God, your luxury is at 8% versus 5%. Let's cut out this 3%. If we're making up the difference somewhere else, it's okay. So you can see on here, like the breakdown, it is, out of the 185,000, this is now, you may be thinking, well, is my salary or her salary 185, and then we have to take taxes out. This is what is coming into her into her account, right? Into her checking account on an annual basis post tax, right? So as a business owner, she has ebbs and flows when it comes to her income. If you're in corporate, you're going to have more steady income, but this is what comes into whatever that account is from the direct deposit is. She is making 185 after taxes. So this is how we were able to divvy out her cash flow. So the second money move is to invest for your life timeline. A lot of times we are unsure of what to do with our money because we inherently know that there's two goalposts. There's the life that we're living today, and then there's this thing called retirement, and that's the other goalpost, and that feels really far away. And like, what do we do with all the space in between these two goalposts? We have a lot of goals. There's a lot of life to be had, a lot of life to be lived. And like, what do I do? How do I save for the goals that are not these two goalposts? So I like to organize these into 4 buckets. So when I'm working with a client, I'm looking at where do they have money, and then assigning a job description based on either the type of account that they have or what are their goals. So if something is short term, I'm considering short term now and the next 3 years because of the economic environment that we're in right now, where we're earning pretty much a really nice interest rate on on a high yield savings account. And if you don't know what a high yield savings account, we're going to talk through that in the next money move. But because we're earning interest in our high yield savings account, we can put money that is meant for our short term in a savings account and earn interest without risking its value. Midterm is at 3 to 7 years. So that sometimes is the gray area, the no man's land in our financial life, where you're like, it's not super long, but it's also not super short. We want to be saving and investing for that particular timeline in a different way than we're saving for our short term. And it's just different strategies, but it doesn't mean that we should either ignore or be saving too conservatively for that timeline or too aggressively for that timeline. Long term is 7 plus years. So this is anything beyond obviously the midterm until retirement. So it could be 10 years from now, it could be 15, it could be 20, it could be 25 years from now. The fourth bucket is retirement. I specifically separate long term and retirement because retirement is specifically age 59 and a half plus. Because when we're working in corporate or we are a business owner, we have particular investment accounts that is solely for retirement. 401ks, traditional IRAs, Roth IRAs, SEP IRAs, all of these vehicles are made specifically for 59 and a half plus age. The IRS tells us how much we can be putting into this account, when we be taking money out of that account. So a lot of times we have a long-term goal that isn't retirement. So if we think about our financial life as a mountain and we're climbing up the mountain, we're building wealth, and we're at base camp today, wherever today is, what that means for you. Again, whether you're making $200,000 or $600,000 or $1 million or anything, $100,000 or anything in between. Today, having this conversation is your base camp. And if we're trying to reach the top of the mountain, we're not waiting to eat or drink until we get to the top of the mountain. We are eating and drinking along the way to fuel our bodies to make that trek up the mountain. So in our financial life, some of our money is meant to fuel our life while we're climbing up the mountain. It's not meant to ever see the light of day for retirement, and that's okay. But we can't ignore retirement or this thing called financial freedom. So when we have money in each of these four buckets based on our goals, it does not mean that you have to have all four of these buckets, because I have clients that really don't have midterm goals. We are saving short term and long term in retirement. If we don't have any specific goal in the midterm that we're specifically saving for, it's okay not to have that. Or on the flip side, sometimes we have a midterm goal that we have the resources to put money towards that, and we don't really have a lot of money, or we don't have the resources in this moment to put towards long term because we're doing retirement. So it's not about putting all four in at the same time. It's just, again, based on your situation, that we want to make sure that we're prioritizing each of these buckets. If we can do all four buckets, great. We're doing all four buckets. If we're sitting on too much cash, we don't need to be adding to our cash position. We're taking care of the last three. I had a client, my client Erica, she wanted to shift careers, right? She was in corporate and she wanted to shift her career in about 5 years, but she was only saving in her 401k. So we shifted her strategy. So when we started working together, we had to shift her strategy. We had to include other types of accounts to give her some freedom, to make sure that she was in a position in 5 years from now to be leaving corporate and starting her own business. So we shifted her strategy. We actually decreased the amount that she was putting into her 401k, and we started to put money into a brokerage account and her high yield savings account. And if this vernacular, the type of accounts, does not make sense to you now, do not worry, because we're going to cover that in number 3. But we got to a place in working together that not only by shifting her strategy, that not only was she able to leave corporate a year before she was intending, before we started working together, but she actually took a 6-month sabbatical before she started her business. So that just shows you the power of intentionality with our money, that when we're putting into the right places for our goals, things are achievable. So, as an example, here is a real life client, my client Jen. She makes $260,000, and she did have goals, right? Some of the goals that she wanted to save for, that were for the midterm. So, her 3 to 7 year, it was a down payment for her home. She had also she was helping out a family member financially that also had a goal that fit into that time frame. So it felt really overwhelming to her that she was dedicating a lot of dollars towards this time frame. And she had a brokerage account that she started maybe 7 or 8 years prior to us working together. She was putting money into it, but she wasn't 100% sure she invested appropriately for this time frame. So a lot of what I will also do for clients when we're working together is we're going to take a snapshot of how are you invested, account by account. So this is something that you can also see when you log into, not in this exact way, financial institutions that you have money invested in, is that you can see a snapshot of how the breakdown of how you're invested. So for midterm, her current brokerage account, what she was putting money in, was pretty much spot on. It was 60% in equities and 40% in fixed income. So the equities were just stocks, and doesn't always mean individual stocks. It means maybe mutual funds and ETFs, and fixed income, which are bonds. So the equities is what is going to be feel more volatile, because we're not guaranteed money or a gain. When you're investing in a company or a collection of companies, which is what a mutual fund or an ETF is, it's not guaranteed that you're going to get your money in return. So that's why we see the up and down in the market. It's okay to experience volatility. But again, if something is midterm, if it's midterm goal, we don't want to be super, super aggressive. So I always like to see a balanced portfolio in how someone's going to be invested. The difference between how she currently was invested, how I changed her investment strategy for this particular account, even though the percentage between equity and fixed income stayed the same, was just a little bit more diversification across different asset classes. Now, for her long-term goals, right, this was now for her 10 plus year goals. This wasn't necessarily retirement, but we can slot retirement into this because of her age at 45. We were 25 years away from retirement. So even if something is 10 years from now, it's 13, 20 years, anything that's long-term goal or retirement, we still can be a lot more aggressive with our dollars. So here she was a lot more conservative than she needed to be in her portfolio. So you can see that instead of having 72% in equities, I actually moved her to 95% in equities and downsized the amount of fixed income that she has in her portfolio. And then again, it's also about diversification. It's making sure that you have the right mix of each of these asset classes within your portfolio, and that you're not overly concentrated in one type of asset class, which could be all in the US, it could be international. A lot of times in our investment portfolios is that we have a lot of funds that are very similar to one another. So we're overly concentrated in all US large cap, which are the 500 largest companies domestically, aka the S&P 500. We want to have that diversification across each of these asset classes. So again, when it comes to kind of changing her investment strategy, she's going to have a better rate of return It doesn't mean that she's not going to experience more volatility, right? There's going to be ups and downs, but when we're looking at the markets in long-term increments, anything 10 plus years, it's 100% positive. So when it comes to our long-term investment strategy, we can withstand the ups and downs of the market. And because she was working for a company where she was getting company stock, part of what she was doing was that she was holding on to her company stock for that. At some point, she's like, I'll do something with this. I don't like to see clients overly concentrated in their company stock, either current company stock or former company stock. Or it could be that a family member or friend said, go buy X because you should buy this company. And because you were newer to investing, you ended up buying a lot of shares and you're holding a big concentration of a particular company. Or I have a lot of clients that also was gifted stock or inherited stock by way of grandparents or parents, and they were buying shares of Apple or Microsoft or Amazon when it was really, really small. And now they're sitting here with millions of dollars in a particular portfolio or a particular company. So she was currently working at Microsoft, and she had a lot of Tesla and she had a lot of Amgen. Right. So these are three holdings. I don't remember why she was holding on to a lot of Tesla or Amgen, but it may have just been from family members, or just because she wanted to buy into Amgen because of healthcare. So you can see that she was holding a lot of Amgen, and her company stock was about through Microsoft was about 78,000, and Tesla. So I don't like to see being overly concentrated. So part of what we want to do is divest this portfolio, right? We don't want to be sitting with all Amgen, and we have to strategically sell these shares. And same thing with Microsoft, and same thing with Tesla, and put that into her brokerage account, whether that is for her long term or midterm. Again, based on her goals, we're putting a majority of it in the midterm with a portion of it going into long term. So some of this stuff, where it's maybe either different investment accounts, the type of different investment accounts may not be making sense in this moment, or these are things that you have on your balance sheet and have had for years, but you're like, I'm not 100% sure what they're doing. This is because we need to be using, which lends us into or leads us into the third money move, is making sure that we're using tax buckets strategically. So we have three main tax buckets for the most part, which is tax deferred, taxable, and tax free. So all these accounts that you have on your balance sheet, 401ks, IRAs, brokerage accounts, they all fit into one or three of these buckets. So we want to make sure that we have money in each of these buckets, because this is how we're going to use our money strategically based on timing and taxes. So most of these accounts, right? But we may also need a refresher around what type of accounts fit into each of these buckets. So tax deferred, what does that mean? Tax deferred means that you are putting money into an account, into the vehicle. I always like to use the car analogy. If you're putting money into this vehicle, aka a 401k, aka a traditional IRA, aka a SEP IRA or simple IRA. The last two are, if you're a business owner, you may have heard that term. If you're in corporate, you know about the 401k. And then the traditional IRA is if you've left that corporate and you roll out your dollars from the company 401k into a traditional IRA. All of these dollars, you are fueling the vehicle with pre-tax dollars, meaning that you have not paid taxes on any dollar that has gone into these vehicles. You're not paying taxes on the gains on a year-to-year basis. That is what tax deferred means, is that you're not paying taxes every single year that you're holding this account. You're holding the value within the account. You do pay taxes when it comes out. So when you're ready to take those dollars out, let's say we're 65 years old and we're like, hey, I'm in retirement or I'm getting ready to retire and I need some money. You now start taking dollars out of this vehicle. Uncle Sam is coming for you. He has his hand out. He is cozied up next to you in your bed. He said, hey, you have never paid me a penny of taxes, so I am going to get my due. So we don't want to have all of our money in this bucket because we're going to be cozied up next to Uncle Sam later on. So the advice of like, oh, just save in your 401k and you'll take care of your future is not good advice. The middle bucket is taxable. This is your brokerage account. So this is an account like your midterm account where you're saving for those midterm goals, like my client Jen, where she was saving for a down payment and helping out a family member with a midterm goal. This is where we're putting money into. For in her case, was 60% uh, equities, 40% fixed income. But it's a brokerage account. What a brokerage account is that you open up an investment account, you bought the vehicle, but now you have to fuel it with money, and the IRS doesn't tell you how much you can put in on a year-to-year basis. But the trade-off is that you're paying taxes on a year-to-year basis, right? So that's when you're getting that 1099 from that financial institution. And when you're going to file your taxes at the beginning of every year, you get a 1099 from the financial institution saying, hey, here's what your dividends are, here's what your capital gains are. It's called a 1099. And even though you didn't sell any shares, you still within the portfolio can be earning capital gains or dividends. So that's the trade-off, is that you can always take that money out when you want to. You typically want to hold it for at least a year, because the IRS will look at any gains that you've held for at least a year, long-term capital gains, which is 15 or 20% based on your income, versus if you hold it less than a year, it's considered ordinary income. So it adds to your ordinary income, meaning that if you make $150,000 and you have a brokerage account and you took all the money out and you had a $40,000 gain and you only had it within 1 year, which is probably unlikely that you had a $40,000 gain, but let's go with my example. The IRS will now tax you on as making income of 190,000. So you typically always want to be holding something for at least a year, which is why it's important to have our short-term bucket, keeping money for our first, for our goals that are 3 years, because again, we want to make sure that we're holding money in the right way for the time buckets. And again, the question I get a lot is, well, what happens if I'm planning something to keep this money for the midterm or even longer term, but something comes up and I really need it. I get laid off from my job and I go through all my savings and I really need this money. You can take the money, because if something catastrophic is happening in your life or something that is big where you're going to need the money, I can promise you're not going to be completely worried about the taxes at that point. So again, it's not like you can't take the money, but again, we want to make sure we're setting ourselves up for success. Real estate, it is taxable. It's just that you're not paying taxes until you sell the property. It's a physical asset. So it's a little bit different than a brokerage account, but you are still paying taxes on those gains once you sell the physical property. 529s, for those of us that have kids, you don't pay taxes on those gains on a year-to-year basis within the 529s, but it is taxable if you don't use it for education. Tax-free, which is the holy grail bucket, which is why I have it around gold, is the Roth 401k. So if you're in corporate and you open up your 401k plan, a lot of times you will see pre-tax, you'll see maybe Roth Basic or Roth 401k or post-tax. This is the difference between pre-tax and post-tax or Roth. It's a completely different vehicle, even though it sits within the 401k. You can have an HSA, which is a health savings account, cash value life insurance. Life insurance in some ways can act as an asset where you can build tax-free dollars. And then you can have this thing called an after-tax 401k. Certain companies, not every company has this, but certain companies, typically big big companies, a lot of technology companies have what's called an after tax 401k. All of these vehicles allow you to put post tax dollars in. So I have already been taxed on my dollars. I'm fueling the vehicle with after tax dollars. And then it allows me to grow tax free. So similar to the 401ks or the tax deferred dollars where I'm not paying taxes on the gains on a year to year basis. But the biggest difference is that when I take those dollars out, because I shook hands with Uncle Sam at the beginning, I don't have to see Uncle Sam ever again in my life. So if we never pay taxes on the tax free bucket and we're paying taxes on the back end with the tax deferred, we should really have a combination of both because I don't want to be cozied up to next to Uncle Sam in retirement. So, in order to mitigate or lessen the taxes that I'm putting into the 401k or these taxable accounts or these tax deferred accounts today to help lower my taxable income, I need to be making sure I'm putting dollars in taxable and certainly tax free buckets. So, I had a client, Amy, both Amy, Joe, and Amy, they were making $310,000 between each other. When they came to me, they had most of their money in tax deferred bucket, their 401ks. They had some taxable account in a brokerage account that they were saving for long term, and they had a small amount in the tax free. The biggest problem when it comes to the Roth IRAs is that the $32,000 that they accumulated in a Roth was something that they put some money into a Roth when they were much younger and their income was under the limit. The problem with the Roth IRA is that there's income limits. So if you're over a certain income limit, you're ineligible to contribute into a Roth IRA. So a lot of my clients will do what's called a backdoor Roth IRA. But a lot of times, like them, like Amy and Joe, is that they had some money in a Roth IRA and then they make too much money. So they could not put more money into a Roth without getting penalized. And they never really did a backdoor Roth. They never put money into the Roth 401k. They just figured, okay, we'll save for retirement by putting money into the 401k. It helps lower our taxable income. Great. We're making more money. We're feeling the pain of taxes. But so it makes us feel good by not having to pay as much taxes today. But again, we're not really setting ourselves up for the future. So this was where we did almost 50% of their net worth, right, was in the 401k and pre-tax dollars. So we had to do a couple of things. Um, because of the way that Joe gets paid is that we put a lump sum into the after tax 401k. So the after tax 401k allows you to actually get more money into the 401k than you typically can. And then within their brokerage account, we added more tax efficiency. So I see a lot of times where we have either purchased mutual funds where you got an ETF and or we took some friends and family advice, or we went on TikTok, we went on Instagram, and we're like, okay, someone told me to buy X, Y, and Z. So I'm having a mishmash of things within my brokerage account, and we're not really thinking about tax efficiency. So that's what's really important, is to also be thinking about tax efficiencies within your portfolio and where you're putting your money. Because Americans, we spend more money on taxes than food, clothing, and housing combined. So it's important that we're not just thinking about taxes once a year. We have to be thinking about taxes all year long. Thinking about taxes all year long, tax strategy, it's not just for the rich, it's not just for the super wealthy. It is something that we have to be thinking about all year long. If we're only thinking of taxes in April and just thinking about tax preparation, oh, I have to get my stuff to my accountant, we are far behind. So when I am working with clients, we're thinking about taxes all year long. So we're thinking about health savings accounts, maybe selling certain positions in their portfolio to offset their gains, charitable giving, or if they own rental properties, depreciation, right? Or thinking about buying a rental property for the depreciation. These are things that we're constantly talking about all year long. So we're not just getting to the end of the year or the beginning of the year and then wondering what our tax situation looks like. And then the fifth move is to make sure that we're protecting and transferring our wealth for the way that fits our life. It is the power silent money move. We need to be having the life insurance, the disability, the long term care, the estate planning, all of these things that can cause a lot of anxiety or like, oh, I just don't want to think about it. I don't want to deal with it, or I don't want to think about not being here or what it means for my family. If we don't think about these things and we're only thinking about our money from an offensive perspective, how to grow our wealth and accumulate all this money, and we're not doing anything to protect it, we're leaving our families with a mess. And we don't want to be doing that. If we're going to be high achieving, high earning women, we do not want to be leaving our families with a mess. And what that means is making sure that we have the right life insurance. We may be getting life insurance through our employer, but that's usually not enough. What do we get? Sometimes we need to supplement on top of that. Sometimes buying the supplemental life insurance through our employer makes sense. Sometimes buying it outside of our employer makes sense. This way it could go with us wherever we go from job to job, or if we're leaving corporate and going into our own business. As business owners, we don't have an employer to give us life insurance. We have to buy that outside. Same thing with disability insurance, is making sure that you're protecting your income. Disability is the biggest misnomer because it means like, okay, I have a disability. No, it means that you're unable to work for a long period of time due to an injury or illness, whether that's physical or mental. It is your income protection. So if you're unable to work for a long period of time, who's going to help you still pay your bills? We want to make sure that we do have disability insurance. We're offloading that to an insurance company, especially as we are building our wealth. I always equate this like you wouldn't go buy a $9 million home without homeowners insurance. So if you are earning an income, whether you're a business owner or in corporate, would you not insure what your greatest asset is, which is your income? So if we work in corporate, a lot of times we do get a benefit through work, but again, it's usually not enough. So we have to supplement. Sometimes we can supplement through our employer, or most of the time we want to supplement outside of our employer. Long-term care, as women, this is so important to be thinking about because we're the ones that live longer than men. And the expenses around long-term care only exponentially get more and more as the years go on. Estate planning. It is important to be thinking about the trusts, the wills, the power of attorneys. We saw this a lot during COVID when a lot of us we were freaked out and unsure about what was happening health-wise in this global pandemic. And so we need to make sure that our assets, that they have beneficiaries, that we have an actual beneficiary, named beneficiaries. Are those beneficiaries updated to who we want to pass that money to? The wills, the trusts, we need what's called a revocable trust. We need to be putting our money or our assets in that trust. So we think about the trust as the home, and then we fill the trust with the assets. So this way, our family members don't have to deal with all the mess if we are not here. Or how do we want to pass on our assets? So even when we're younger, it's not about like, oh well, I'm older now, I'll start thinking about my trust. It's like, God forbid something happens to you, you want the life insurance, right? The life insurance provides a financial band-aid to help the emotional impact of a premature death. And I always tell my clients when we're working together, it is making sure that we have enough insurance. So this way, the spouse or the family member, anyone who's financially relying on you, isn't worried about going back to work the next day or the next 6 months. They take time to grieve and they're not having to worry about earning income, at least for 6 months to a year. Now, going back to the estate planning, trust, wills, these things are important to how to pass on the generational wealth and not having to go through this thing called probate. Every state has a different process when it comes to probate and expense. And I can promise you, here in California, probate is very expensive. So if your thought is like, oh, whatever, I'm not here, I'll let them deal with it. Well, most of most of their time, money, and energy will be going into the court and having to deal with it. That it could be you can avoid that by having a trust. So as part of my financial planning when I'm working with clients, we factor in the estate planning. We make sure not only do I make sure that you have a full financial plan, but I also make sure that you have a full estate plan and execute upon that estate plan. So those are the 5 power money moves. And now it's your time to ask yourself, like, which one of these is costing you the most right now? And as I said to you at the beginning, that you're not going to be able to implement all of these at once. Not all of these are going to be an area of weakness for you. One may be an area of weakness, two may be, or all of these are things that you may need to work on. But if you can look at what can I do over the next 30 days to just be a little bit, take another step further. Let's work on that for the next 30 days. And then we do one of the other moves. It's our financial life, again, is always going to be dynamic and it's constantly evolving and moving. So it's not about vilifying yourself and saying, yeah, I need to do all of this. And now I have to, like, everything that Renee said, I'm going to, like, I need to do. We always want to be doing things in piecemeal chunks so it doesn't feel overwhelming, but we want to make sure that we have all of these pieces in place. So if you're feeling ready to feel finally confident with your money and those decisions, again, I always like to think about this as a full circle, right? So if we're working on each of these areas over time, when I'm working with clients, we are handling all of this over a 3 to 6 month period. And then we're going into just making sure things are getting updated and monitored and adjusted over time. But we're doing this over a shorter period of time, but we're not doing everything at once. So now you may be thinking, like, how can I apply this to my situation? Well, this is exactly what I do at Nexo Wealth, and this is what I do for my clients. And I like to organize this into a 3-step framework because I love my frameworks. So if it's not the shift framework and those 5 money moves, I like to then organize this into a 3-step framework. So what I work with clients is the clarity formula, where this is where we simplify your cash flow, we determine your goals, making sure that money has a job description and it's being allocated the right way for your goals, because we all have different goals. And then step 2, it's the wealth maximizer, where we're investing for your timeline, your life timeline, and making sure that we're using your tax buckets strategically and thinking about taxes all year long. And that's when we're going into the what I call the legacy blueprint, your insurance planning, your estate planning. So if you need help putting all of this, tying this together, because again, this is a lot of information and we've spent the last 55 minutes together. It's not meant to do everything at once. And this is not meant for you to get all the wealth of information that you possibly need when it comes to your money in a short period of time. If you need help tying this together, like I said at the beginning, I am offering a wealth clarity session. So just click on that, the QR code, and we will schedule time. It's not meant to be a pitch. It's not meant to say, hey, we're going to work together, because I always like to make sure that it is a good fit. I can only bring on a certain amount of clients every single year. So I cannot work with everyone, but I want to make sure that this information is getting out to everyone. So if you want to have a clarity session, please use that QR code. And otherwise, follow me on Instagram and on LinkedIn, or email me. I'm happy to answer any of your questions.